Hello, everyone, and welcome to SPL Tutorials. This is your preferred online learning platform. And I want to take us through an overview of financial management. That is paper number 8 of the new CASNEB syllabus. In our previous sessions, we looked at an overview of financial management introduction and defined what financial management is. We also looked at the goals of a firm. Now, in this session, we shall look at two theories in the overview of financial management. And the first such a theory will be the agency theory. And then we'll finalize with the stakeholders theory. Now, when we talk about the agency theory, we are talking of an agency relationship. Now, an agency relationship arises when one or more parties known as the principal contract another party or other parties that we are going to call the agent to perform on their behalf some services or tasks. Now, this will include delegation of decision-making and authority. Now, a number of key terms and concepts are essential to understanding agency theory. And the first such explanation is that an agent is employed by a principal to carry out a task on their behalf. For example, the management will hire managers who are skilled to perform their duties on their behalf. So an agent is employed by a principal to carry out the tasks on the behalf of the principal. Secondly, agency refers to the relationship between the principal and their agent. Agency costs are incurred by principals in monitoring agency behavior because of lack of trust in the good faith of the agents. For example, we need auditors to verify whether the management have done what they are expected to do. And that will be an agency cost in form of audit fees. KRA will send their officers to check whether we have paid taxes in full because of the lack of trust, and that is agency cost because we are agents of the government as an entity. Now, by accepting to undertake a task on their behalf or on behalf of the principal, an agent becomes accountable to the principal by whom they are employed. The agent is accountable to that principal, and they must be able to account on how they have utilized the resources at their disposal in furthering the interests of the principal. Now, in the field of finance, shareholders are the owners of the firm, but they cannot be able to manage the firm on their own because, number one, there are too many to run a single firm. For example, East African Breweries has 25,000 shareholders. How can each of these shareholders run the firm? Number two, they may not have the technical skills and expertise to run the firm. And thirdly, they are geographically dispersed and may not have time to run that firm. And because of that, then various agency relationships exist in finance. The first one is shareholder as the principal versus the management as the agent. The second one is the creditor as the principal versus the management again as the agent. Thirdly, we have the shareholders as the principal and the auditors as the agent. Then we have the government as the principal and the management or shareholders as the agent of the government. Now, let's start by discussing each of these agency relationships one by one. We'll right away start with the shareholder as the principal and management as the agent. Now, shareholders contribute equity capital finance, which management is entrusted with for investment purposes. In other words, they will give their equity capital in form of purchasing of the shares, and they expect that the management will invest that money and have a return to them. At the end of every financial period, the management and directors of a company are expected or are required to report to the shareholders on how they have utilized the financial resources of the shareholders at their disposal. This is known as stewardship accounting. This is known as stewardship accounting. Now, it is expected that management acts in the interest of the shareholders. It is expected that management acts in the best interest of the shareholders. However, there are instances when a conflict of interest between the management and the shareholders can arise. And this is what we call an agency problem, where the management may not have acted in the interest of the management, and therefore an agency problem will have arisen under agency theory. Now, this agency problem can arise due to the following, or how can the agency problem arise? Number one, it's through creative accounting or window dressing, whereby the management is trying to please the stakeholders, the investors and potential investors by doing some creative accounting, or window dressing, in which case they are trying to make the financial statements look well when they are actually not that okay. Now, creative accounting involves manipulation of the books of account to reflect high profits. For example, by manipulating stock valuation methods or by using depreciation methods that inflate the profits so that the company can be seen to be performing very well. Then number two, we can have management buyout. We can also call it MBO. And this arises when the company is undervalued due to poor performance of the management, with the intention of making the shareholders to sell off the firm so that the management can now buy it. The management and the directors can buy it. We are undervaluing the firm so that the shareholders can see the firm is of very low value and decide to sell it off. Then as management and directors, we purchase that firm. That is a conflict of interest because we will not have acted in the best interest of the shareholders who are our principals. Again, how can we remedy this conflict? How can we resolve this conflict? Now, the conflict can be resolved as follows. Number one, use of executive or employee share option plans. We usually call them ESOPs, so that we are incorporating them as part of the management, as part of the ownership of the company, so that they also have that ownership feel and they can be able to do the work as if they are doing to themselves. Number two, we can threaten them with hostile takeover as the shareholders, threat of hostile takeover that will do as hostile takeover of the company, and therefore they'll miss whatever they have been earning from the company. Then we can attach or peg management compensation with financial performance. This is what we usually call performance-based remuneration. We want to peg or we want to attach the management compensation with financial performance. Then we have direct intervention by shareholders. When things have gone haywire, as the shareholders, we can decide to directly intervene and even remove the directors and the management from office. We can develop a code of practice by shareholders and the capital market regulators, which will prescribe the required or set code of conduct or code of practice by the management in terms of how they should be able to run the affairs of a company. We can incur agency and monitoring costs by, for example, hiring auditors to carry out the work of checking whether everything is being done well, and monitoring and evaluation agents. So that's how we can be able to resolve that kind of conflict or agency problem between the shareholders as the principal and the management as the agent. We straight away move to the second kind of agency relationship, and this will be the relations between shareholders or management versus the creditors. In this case, the creditors are the principal, and the shareholders and the management will now have become the agent. Now, creditors or bondholders or even debenture holders provide or lend finances, both short-term and long-term, to the company. So they are debt capital providers. They provide capital to the firm on the basis of the assets credit rating of the firm. And it is expected that management and shareholders will act in the best interest of the creditors by paying the loans and interest thereof as and when they fall due. That's the expectation of the creditors. However, an agency problem may arise when the shareholders and managers take the following actions, and these will be actions in contravention of or that are not in the interest of the lenders. Number one would be disposal of assets used as collateral. You have taken a loan and a motor vehicle has been used as the collateral. You decide to sell off or dispose of that motor vehicle without informing the lender that you're selling off the motor vehicle. Then in that particular case, you'd have done or you would have caused an agency conflict. Payment of high dividends can also be a source of high conflict because it means you might pay dividends even out of retained earnings and therefore destroy or erode the available resources that can be used to repay the loan and the interest thereof. We can also have overborrowing or borrowing beyond the value of the company's asset base, and that means that you are, in other words, diluting the assets that the borrowers can be, the lenders can be able to use in recovering their debt. How can this problem be resolved? The remedies to this conflict between shareholders and management versus the creditors can be resolved as follows. Number one, we can seek representation in the board of directorship in order to safeguard the interest of lenders. So you can call it representation. Seeking representation in the board of directorship so that we can be able to safeguard the interest of the lenders. Secondly, we can include callability provisions in loan agreements. And these are those provisions that permit the lenders to require the borrowers to pay off the debt before maturity in the event there is a breach of the terms and conditions contained in the loan or bond. So we want to include some callability provisions that in case you're not going to adhere to the loan agreement or you breach any of the provisions in the loan agreement, we will be able to ask you to pay the loan immediately without considering when the loan is maturing, so that we can be able to safeguard our interest. Then we can have refusal to lend, whereby the lender can refuse to lend to the borrower if they do not meet minimum conditions that they have set. If they do not meet the minimum conditions they have made, then we have including restrictive debt covenant provisions in the loan agreement, or which means imposing strict terms and conditions to the borrower so that they don't just make decisions on their own whimsically. Now, such restrictive covenant provisions would include no disposal of assets without the lender's permission, restriction on mergers and acquisitions, no payment of dividends from retained earnings, no borrowing of additional debt before the current debt is serviced. And then that's how you can be able to cater for yourselves as creditors as a remedy to the agency problem. The third agency problem or agency relationship would be between shareholders and auditors. Now, shareholders as the principal appoint auditors as the agent to look into or to examine the financial statements of a firm independently during a given financial period. The auditors are then required to report to the shareholders whether the financial statements taken as a whole are free from material misstatement, whether is it due to fraud or error, and have been prepared in all material respects in accordance with the applicable financial reporting framework. Now, an agency problem can arise, however, due to competition for clients, whereby auditors may not discharge their duties in the interest of shareholders, and this can be in the following ways. Number one would be failure to apply professional due care and diligence in the performance of their duties. Now, an auditor must adhere to the professional due care and diligence requirement as one of the professional conduct requirements, that whenever they are going to issue a report, this report is going to be used by a number of stakeholders, investors and the others, in making certain decisions. Sometimes they can fail to apply the professional due care and diligence in the performance of their duties, and this can bring in what we call the agency problem. Number two, demanding a very high audit fees. If you are demanding very high audit fees, that's an agency problem between us and the shareholders. Number three is colluding with management in performing their duty, and thus this will compromise on their independence. Remember that an auditor is expected to be independent both in mind and in appearance. So by colluding with them, it shows that you are not that independent. Expressing an opinion that the financial statements are true and fair when they are in actual sense having material misstatements is a conflict of interest or is an agency problem between the shareholders and the auditors. How can this be resolved? The following actions can resolve this agency problem between the shareholders and the auditors. Number one, removal of the external auditor from office during an AGM or SGM. The Companies Act allows the auditors to be removed or gives the shareholders the power to remove the auditors in any annual general meeting or even in a special general meeting whereby the auditor may have misconducted themselves and they need to be removed by a special resolution. Seeking legal remedy for any misleading reports issued by the auditors is a second action that can help in resolving this agency problem. We can seek legal remedy for any misleading reports that we have used in making decisions, and this has caused us some financial loss. Seeking disciplinary action to rogue auditors by their regulatory bodies, for example, ISPAC, so that we can report their rogue actions to the regulator like the Institute of Certified Public Accountants of Kenya, so that they can reprimand them, they can fine them, they can strike them off the register of auditors, and in that case, we would have resolved the agency problem. The fourth relationship or agency relationship is that agency relationship between the government and the shareholders or the management as the agent. So we are the entity is an agent of the government who is the principal. Now, management and shareholders of a company act as agents of the government in the following ways. Number one, by paying taxes. They should pay taxes, actual and correct taxes should be paid, providing employment to citizens without discrimination of gender or race or marital status, and making sure that the employees are working in environments that are conducive and safe to work, Protection of the environment is another way that a company will act as an agent of the government. Now, there are instances when management and the shareholders may not act in the interest of the government, thus creating an agency problem. The following actions now can resolve this agency problem. Number one, the government can seek representation in the board of directors in a given firm in order for the government's interests and those of its citizens to be championed. Number two, the government may require conducting regular investigations on the affairs of the entity through various regulators, for example, the Central Bank of Kenya, the Kenya Revenue Authority, the Capital Markets Authority, the Insurance Regulatory Authority, the Retirement Benefits Authority, and other players to ensure that the entity is acting in the interest of the government. So you can check, for example, on KRA investigations that usually are done by the KRA on entities to check whether the entity has declared all the taxes that it should pay and paid them correctly. Then we have instituting policies aimed at ensuring that firms act in the best interest of the government. We need to have policies in place that ensure that firms are compelled to act in the best interest of the government. Now, having stated that, we now want to go ahead and look at another theory, and this is going to be the stakeholders theory. Now, stakeholder theory states that a company owes a responsibility to all stakeholders other than just shareholders. A stakeholder is defined as any person or group which can affect or be affected by the actions of a business. Stakeholders would include employees, customers, suppliers, creditors, and even the wider community and the competitors. Now, according to Edward Freeman, who is the original proposer of the stakeholder theory, he says that corporate social responsibility, a concept which recognizes the responsibilities of corporations in the world today, whether they are economic, legal, ethical, or even philanthropic, is an important element of stakeholders theory. Now, nowadays or presently, some of the world's largest corporations claim to have CSR at the center of their corporate strategy. You can see so many companies doing CSR activities, and they claim that these are at the center of their corporate strategy. While there are many genuine cases of companies with a conscience, many others exploit CSR as a good means of public relations so they can improve their image and reputation, but ultimately fail to put their words into action. Now, within an organization, there are a number of both internal parties involved in corporate governance as well as external parties that are interested in the affairs of the entity. Now, for internal parties, we call them internal stakeholders. A useful definition of a stakeholder for use at this point is that a stakeholder is any person or group that can affect or be affected by the policies or activities of an organization. Yeah, so now those are the many stakeholders that we can talk about: employees, management, customers, suppliers, creditors, community, the government, the general society, environment, future generations, shareholders, you can name them. There are quite a number of them. Now, for the internal stakeholders, each internal stakeholder has an operational role within the company, and they have a role in the corporate governance of the company, and they have got a number of interests in the company, and these are called stakeholder claims. Now, for example, if you talk of management as an internal stakeholder, their operational role is that they are responsible for the actions of the corporation. The corporate governance role is that they control the company in the best interest of the stakeholders or other stakeholders. The main interest in the company is they want a better pay, they want performance-linked bonuses, they want share options, they want status in the company, they want reputation and power. The company secretary operational role is a stakeholder. The corporate governance role is that they advise the board on corporate governance issues, and their main interest in the company is the remuneration. They be paid their dues. The employees' operational role is that they carry out orders of the management. The corporate governance role is that they comply with internal controls. They report any breaches to internal controls, and their main interest in the company is pay and career progression. Employee representatives, for example, trade unions, operational role is that they protect the employee interests, and the corporate governance role they have is that they highlight and take action against breaches in corporate governance requirements. Their main interest in the company is power and status. Now, for the external stakeholders, each external stakeholder has a role to play in influencing the operations of the company, and they have their own interests and claims in the company. For instance, if you have the auditor as an external party, their main role is independent examination of a company's reported financial position, and their interest and claims in the company would be fees, reputation, quality of the relationship they have with the management of the company, and compliance with audit requirements. We have regulators as the second external party or external stakeholder. Their main role is implementing and monitoring the regulations, and the interest they have and claims in the company would be compliance with the regulations and effectiveness of the regulations. The government is an external stakeholder. Main role, implementing and maintaining laws with which all companies must comply. Their interest and claims is compliance with laws and regulations, payment of taxes, levels of employment, levels of imports and exports, for example. The stock exchange, it can be another external stakeholder. The main role is implementing and maintaining rules and regulations for companies listed on the stock exchange. Their interest and claims in the company are compliance with the rules and regulations and fees. If we have institutional investors, they have a main role that through considered use of their votes, they can and should beneficially influence corporate policy. In fact, institutional investors are usually entities like companies, let's say, for example, Britam Insurance Company investing in another entity. In this case, the institutional investor is experienced and they have the power to vote and make decisions or help the management and the board in making decisions in the best interest of other investors. The interest of the institutional investors is value of shares and dividend payments, security of funds invested, timeless of information received from the company, and shareholder rights being observed. External party investors, as a stakeholder, their main role is limited power with use of vote, and their interest and claim is maximization of shareholder value. Remember, we talked about shareholder value maximization as one of the goals of a firm in our previous discussion. So friends, that marks the end of our session for today. In our session, we have looked at two theories in the overview of management. The first such a theory was the agency theory. And we said that an agent is that person or group of persons that are given the power and the authority to make decisions on behalf of another, and this other we said is the principal. And we said that an agency problem might arise when the agent does not act in the interest of the principal. We went ahead and talked about the various agency relationships that can exist in finance. We talked of shareholder versus management relationship. We talked about shareholder or management versus creditors. We talked about, number 3 was shareholders versus auditors. And then lastly, we had government versus management or shareholders. We also looked at how these conflicts or agency problems can be resolved. Again, we then went ahead and looked at the stakeholder theory. And we have stated that the stakeholder theory states that a company owes a responsibility to a wider group of stakeholders other than just shareholders. And a stakeholder, we have defined them as any person or group which can affect or be affected by the actions of a business. So we went ahead and looked at the various stakeholders that can be internal and external. We can have direct or indirect stakeholders and many others. So this marks the end of our lesson for today. I thank you.